Hello, this is Anthony Parent of Parent LLP, the IRSMedic, and thank you for joining me on our 2014 FBAR penalty guide. And this is recorded October 9th, 2014. Unfortunately, my partner, Michelle Wynn, could not be on this one with me. She's a little busy. We have some deadlines coming up. So I'm going to handle this myself. And this is everything you never wanted to know about the FBAR, but must. And this is my third version of this. So we added a whole bunch of material since the last one, some information we found out about soft disclosures. So this is something that's really important to watch. And just a little bit about us. We're IRSMedic, Parent and Wynn LLP. We're tax resolution attorneys. We are based in Connecticut, and we serve our clients worldwide. Again, we're adding some new information to this. This is not a substitute for legal advice. This is to give you a general outline. The FBAR has been catching people still by surprise, even in 2014. So you might not know everything about it, whether you are someone with an FBAR filing requirement or a tax professional yourself. We hope this helps you out. So this is where I start, is with my history lesson, and we just think about those groovy good times of the 1960s with international drug traffickers, money launderers, and terrorists, and all the fun they were having back then, right? Well, the government didn't think so, and a lot of people didn't think so. And here's the real issue with these type of people. They're mean and nasty, and if you try to bring them to justice, they will probably, I don't know, maybe murder your family, right? So who the heck wants to go and prosecute them? So law enforcement was really looking for a different way to go after these people and to shut them down. So they said, well, you know what? The power of the purse, right? That's really what they went to attack. The criminal enterprises had the upper hand. They can open up bank accounts freely, wires wherever they wanted to. There was actually secrecy. So all these criminal enterprises were well funded, had 100% access to the money at any time they wanted to. So these were the people that the prosecutors who really would want to trust, who would want to go after one of these really mean and nasty guys that would take a 4 or 5 year indictment, and who knows who they're going to pay off, or maybe they're going to threaten you or your family. And it's very difficult actually to charge something like Al Capone tax evasion case. It's actually very difficult. There they did a lifestyle audit. They also had people on the inside helping out tremendously, but it's still a very difficult and onerous task that it takes a lot of agents, a lot of personnel to bring someone like that down, and you might not actually end up with all that money. So this is what the idea was, and this is actually really one of the most important things, and this helps you understand the fundamental nature of the FBAR and how it is different than a tax obligation. So the law, there was a Bank Secrecy Act of 1970, created an obligation for any U.S. person to tell the U.S. Treasury, in particular the Financial Crimes Enforcement Network, of any bank account that was worth, or financial account that was worth over $10,000 through the year. Okay? And that was in 1970. And now the limitation is still the same, $10,000, as if inflation didn't occur. So that is an affirmative duty they created on people with foreign financial accounts to report these accounts, whether or not there was any criminal activity taking place. Now, do you really think that they were expecting criminals to file their FBARs? No, of course. They expected nobody to. But the fact that they didn't would give them the upper hand, because now the law is written, this FBAR penalty, if you willfully don't file an FBAR penalty, we'll get into that willful part a little bit later, you can be assessed 50% of account value per year. And so the intent of this law, the Bank Secrecy Act, this is the law that gave us the FBAR form. The intent is to allow the U.S. Treasury to impose a 300% penalty on the bank accounts of worldwide criminal syndicates, because the statute of limitations would allow 6 50% penalties. And so there we can estimate, yeah, that's about 300%, right? That should shut somebody down. So this is what it was, Bank Secrecy Act of 1970. This is also the act where you find if your bank notices suspicious reporting. This is also, it comes from the same place. that your bank has to report suspicious activity. So this is the thing. It's a Title 31 from the U.S. Code, not Title 26. Title 26 is the income tax. Title 31 is where you find your Bank Secrecy Act. Okay, remember it's over $10,000 in the aggregate. That's what it started out in 1970. That's what it is today. So if you had 10,000 $1 accounts, you have an FBAR filing requirement. Again, this is the act that created FinCEN, Financial Crimes Enforcement Network. So it's been around. The FBAR has been around since 1970. But if you went and asked, say, a CPA 15 years ago, 10 years ago, what's an FBAR form? Do you file them for your clients? I would guess to say about 15% would know about it and actually did do them for their clients. Because here's the thing, it had nothing to do with taxes. It's based on account value, not taxes. And really the whole purpose of the account was not to combat tax evasion, but rather these criminal syndicates. So if your clients are just regular people, why would you file an FBAR? And here's a question, and I've asked some criminal attorneys this question. I haven't heard back yet. How many FBAR penalties, this is the question asked, since 1970, how many FBAR penalties and convictions have there been for terrorists and drug traffickers? Okay, that's the answer I have right now. I haven't heard of one. If you actually look to see how many FBAR penalties are assessed, it's always somebody's whose underlying offense was tax evasion, right? But the Bank Secrecy Act of 1970 really wasn't passed to combat tax evasion. There was already penalties. There are penalties for tax evasion. So that's really one of the strange things about this, or not so strange if you understand how government power works, is that this law is used in a way that it wasn't intended to. It was intended to go after the worst of the worst, and now it's regular U.S. Taxpayers who might have been unaware of something that are the target. You know, and I think this is the way to think about it, is that when Prohibition was passed, that everybody said, okay, intoxicating liquors, no interstate sales, manufacturer of intoxicating liquors. Well, then the Volstead Act was passed and said, yeah, let's get rid of everything, even beer. Now, in what world do you exist in where liquor means beer or wine, right? Is that what you say when you go to a bar? Oh, give me that. This liquor's great. The hops, oh, it's wonderful. Look at this fruity bouquet on this liquor. Of course, we all know liquor is liquor. Beer and wine are different things. But that didn't stop the government, right? Didn't stop the government from claiming liquor is beer. And that's what was in all forms of alcohol greater than 0.05% were outlawed. Unless you can get a license, of course. So it's the same thing. You know, your willful non-filing, they've turned that in from, you know, your willful, you know, the context of a willful FBAR non-filing meant that you were engaged in one of these mean and nasty crimes, drug trafficking, money laundering, terrorist financing. Now they've turned that to mean tax non-compliance. Now, I want to talk about late FBAR filing penalties. There are none. Isn't that strange? If you file late, there are none. There's late tax filing penalties, right? But there's no late FBAR filing penalties. It's just one of those strange things because it really wasn't a tax-related thing. And it makes sense when you try to, when you understand the true purpose of it, it makes sense that you wouldn't have a late filing penalty. You just have non-filing penalties. You know, so now there's two categories, willful and non-willful. And the worst willful penalty amount is calculated. And this is a strange thing. This is very strange. The worst willful penalty is calculated as the account balance on the June 30th of the following year. Okay, so let me put it, let's just say that for 2013, you had an FBAR filing requirement, and the account balance was $1 million. And you did not file an FBAR by June 30th, 2014. However, on June 29th, 2014, you moved that entire $1 million and opened up a brand new account somewhere else. So let's suppose the IRS catches wind that you did not file an FBAR for 2013. Well, this is the thing, and this is sort of how the law was written, and if you're a little bit clever, and I wouldn't advise this, and there's other laws that the IRS can get you on, but just to show you how weak this law can be, your FBAR penalty base would be $0 because it's based on the June 30th of the following year. My example, the bank account that you did not file an FBAR for was $1 million during 2013, but on the date of June 30th, 2014, the due date of your FBAR, it's down to 0. You moved everything out. Well, it's a 50% penalty of 0. That is 0. So one of those strange things that, laws are passed, I guess, for reasons, but sometimes everybody doesn't quite think about the impact. So what we have is, I want to talk about FBAR penalties outside an offshore voluntary disclosure program. Things are different inside. So let's just say that you're audited, okay, and that you didn't do a soft disclosure. You're just audited. And an IRS agent is finding out that you have unfiled, or you have foreign bank accounts and accounts greater than $10,000. So we have two types of penalties. We have our willful and we have our non-willful. Now here's the thing. How do you ever prove a willful FBAR penalty? That the FBAR form is something that people don't know about. Well, the IRS looks to say, well, you are willfully blind. It's something you could have found out if you actually read the instructions to your tax return. Of course you would, right? All 300 pages of that. And if you looked at Schedule B, section Part 3, you'd also see something that asked you about if you had accounts over $10,000 and to notify you of your obligation to file an FBAR. So the IRS will take that, the fact that you didn't read a return, you didn't know that. In some instances, they'll try to spring that into a willful blindness that you could have known if you tried to find out. Well, that is what a lot of people do think, but it requires a little bit more. Just checking, something very important to know, just checking Schedule B Part 3, no, is not enough to spring a willful penalty. And the Internal Revenue Manual says that. You have to look at a bit more of the facts. Right? Whenever we look for an intent, we never can scoop out somebody's brain or take an MRI of it, no matter what we're looking at, no matter what penalty we're looking at. We have to look at all of the evidence. And so when you go to a willful or a non-willful penalty, it's really making sure you're getting out all the best facts that show that you didn't know about it, nor did you take steps to avoid knowing about it. So really what you're looking to do is avoid that willful penalty. The IRS, I don't know if we've seen a case where they have assessed more than one 50% penalty. Oh yeah, I think there's a handful, but usually those are just looking to assess one 50% penalty. That's enough to ruin somebody, right? And then if there's a non-willful penalty, that's $10,000 maximum, but there's a whole bunch of mitigation guidelines that can lower your non-willful even less than $10,000. And even if you're non-willful, you might just get a warning letter as well. And even with willful, that 50% is the maximum, and there's mitigation guidelines on that. Now again, as we're talking about this, right, are we bringing up any of the purpose of the FBAR filing requirements? Is the IRS, right now the IRS is in charge of administering this, but is the IRS making any inquiry as to whether or not you were engaged in money laundering, terrorist financing, anything like that? No, they're simply saying, we don't really care if there was even tax due. If you didn't file it, we're entitled to give you penalties. That's how we're reading the law. Now, of course, in context, that makes no sense, but, well, I guess that's the way things are. Now, if you are outside of an OVDP, you do have some criminal pressure. And really, the IRS, it seems like they're saving those for really where cases that are clear-cut. The IRS does like to prosecute people. They like to prosecute people to get press releases, and they like to win. So they want to make sure that somebody did something that is really hard to refute, some sort of action that would lead to a willful penalty that doesn't have a great explanation, so that they can really nail someone to the wall and get them to agree to an FBAR penalty as part of a plea deal. So in cases where the facts are a little bit murky or unsure, criminal pressure might not be there. The IRS still only has, or the Department of Justice still only has about room for 3,000 indictments a year. So there's all sorts of people. They want to indict, and a lot of people are involved in stealing tax refunds and identity theft. They need to go after those people. So they don't have the room to prosecute everybody criminally. They really want to go for people who do things obvious. And I'm going to get to that, what makes you obvious, in a second, in a few slides. Now I want to talk about FBAR penalties inside an OVDP opt-out. In this case, you have no criminal pressure. You're inside the OVDP and you're opting out, and you could be assessed a willful. I haven't heard of it inside an OVDP opt-out, or you could be assessed a non-willful, and that's even this is the thing you need to understand, that the FBAR penalty is not a tax. Okay, the Treasury, it's not a tax. The IRS can send you a tax bill. It doesn't need to go to court. Doesn't need to get a judgment. Send you a tax bill. You don't pay it. All they need to do is send you a few notices. They can start enforced collection, that is levy, seize, lien property of yours. Well, FBAR penalty is very, very different. It's like if your bank failed to report a suspicious transaction, right? The IRS just wouldn't send them a bill and start collecting. No, they would have to sue. They would assess, the IRS would assess the penalty, but now they have to sue in federal court. So this is the pressure that they're under when this is the constraint that the IRS is under. When they assess, when they assess a willful penalty, it's like, well, now they've written a check. Okay, great. You've assessed a willful penalty. Now go enforce it, because now they have to sue and devote a tremendous amount of resources in a forum that's, it's a federal forum, but it's not their home court. There is a federal judge there who, they do tend to favor the government, but they're not going to rubber stamp the government. And also, there's going to be litigation. They actually have to reprove the willfulness that they're going for and devote tremendous amounts of resources that the IRS District Council needs to get involved. And here's the thing. There's no criminal pressure for them to say, for the IRS to say, well, you will charge you with a crime if you don't agree to this. They don't have that. So they actually get a little, in cases where maybe the facts are a little questionable and you're an opt-out, I haven't heard of a willful penalty being assessed. They really are looking to stick to a non-willful, maybe $10,000 per year, and then in a lot of cases simply no penalty at all. But a lot of this has changed as the IRS has created new OVDP programs. I also want to talk about FBAR penalties with a streamlined OVDP. These were things, and we covered the streamlined OVDP, how those work in my last webinar that I recorded in July of 2014 on that. And so you could check that out. We'll have a new one coming up soon with some updates. But essentially it's this: if your certification was justified, you will be assessed no FBAR penalties in this situation that you are selected for an audit. Otherwise, you're going to get your 0% penalty if you are offshore, or a 5% in lieu of FBAR penalty if you are domestic. And here's something to think about. The IRS, they're very good at issuing press releases, and they said, oh, we're the kinder, gentler IRS. We push this new streamlined program because we want to be fair to taxpayers. Well, I would just say if you wanted to be fair, you'd only assess FBAR penalties against the actual intent of the Bank Secrecy Act of 1970. That's the people who are actually engaging in crimes other than tax evasion. So let's just back off from that. But really, the streamlined rules were changed for, I'll be honest here, the IRS's benefit. The IRS did a fantastic job of agitating so many people who really didn't do anything wrong or much wrong into going to a full OVDP program. And this is true for us. We submitted so many that the IRS was overwhelmed. And so they changed the rules for their benefit, okay? And yes, this is some editorialization, but I think I haven't seen anything to indicate that I'm incorrect about this. And it's also something that agents told us. They said, yeah, we're going to change these rules just because we don't have the time to get to everybody. So even people who... most people that we're talking to are doing a streamlined. Where we're not doing it is where there is actually some real, true criminal exposure. And so those cases are something that you would talk to your attorney about whether or not streamlined would work for you. don't want to get too much into that because this is really what I want to talk to, and some big news that's come out. And we've talked to, remember what I said a few slides back about how the IRS wants to get that slam dunk willful penalty? They want to get something that says, oh yeah, you knew, here's the proof, pretty much irrefutable proof. Well, we had an auditor in our office a couple weeks ago, and he was here just on a typical domestic audit. But we started talking to him, as we do, just to see, how everything's going in his life. And he starts talking about a audit he was doing for someone who made a soft disclosure. He told me that the taxpayer actually didn't know he did a soft disclosure. It was somebody else who did it for him. And so the auditor was thinking, this guy's not willful. This taxpayer didn't really even know what was going on. Well, the higher-ups at the IRS said, that doesn't matter. This guy did a soft disclosure. We don't care who advised him to do it. It's his signature on the soft disclosure. And just to let you know what a soft disclosure is, that's something where you just file some amended returns, maybe missing FBARs, but you don't go through a OVDP program. Okay, so that way you avoid any penalties, and you just want to fly under the radar. Well, this is somebody who really didn't know what he was doing, signed a bunch of stuff. The auditor himself says this guy's not willful. He's sort of a victim of a guy who kind of took his money anyway. Why should we punish him more? Well, the IRS higher up says, nope, this guy's a perfect example of somebody we can get a great press release for by slamming with a 50% FBAR penalty. And that is what has happened. And that's really sort of the scoreboard, or you need to know the trend of things. That if you go into a program the IRS wants you to go into, the one that they tell you to, yeah, it might take a little bit of time, and it might be a little bit more money than you want it to spend, but at least it actually puts it to bed. And this is where the IRS is giving its attention. This is where I really want to focus people. I've told people this, and in a way, and I'm not telling you to do nothing, but in a way, I'll ask you this question. Aren't you better off doing nothing than a soft disclosure? If you do nothing, well, what proof is it that you knew about your foreign obligations? You're trying to prove a negative. However, if you go and do a soft disclosure, well, there is a substantial, at some point it's like, well, what gave you the idea you needed to file amended returns to include your foreign income? What gave you the idea that you needed to file an FBAR? So are you saying in all this conversation and the people that you talked to, nobody told you that you needed to file an OVDP? And are you saying during this time there's not going to be anything on your internet browsing history where you came across something called OVDP? And there's not going to be anything where you said, and there's no conversations of you speaking to an attorney or CPA who recommended a soft disclosure. Oh, by the way, what we've noticed is that this CPA or attorney, they've prepared all these amended returns for other people who did the same soft disclosures. Oh, and by the way, now they're trying to save their skin, and now they're telling that it was your idea the whole time. Yeah, this is why we've never advised that. This is why we've always come out strongly against a soft disclosure, and a lot of people have mocked me. A lot of people still are mocking me, and it's fine, but none of our clients are going to be in a worse position after hiring us. So really, this is the thing, and this is really the point, is that if you did make a soft disclosure and the IRS hasn't gotten to you, get into a program now, because this is what they have this is what they're going for. They want to assess willful penalties, even for cases where people aren't willful, to send that message. Don't do a soft disclosure. Wow, that was a happy way to end this one, huh? But this is Anthony Parent of Parent and Win. If you are having some FBAR issues, wondering about what your requirements are, we have an FBAR hotline, 888-477-4258. You can email us at info@IRSMedic.com. I'm going to also advise you to subscribe to this channel because you'll be alerted to live events. I am going to be updating I'm going to be redoing a whole bunch of webinars. I'm going to be doing my OVDP webinar again. I have a tax lien one that I need to update. I have an IRS debt settlement. My dad promises me one on IRS tax audit defense, and I think also payroll tax negotiations. So we just are out here trying to give some information to help people out. So again, please subscribe. Also, look for my book coming out soon. IRS Confidential. It's going to be out probably sometime in November is what we're looking on for. I'm busy making my edits to it now. So this is Anthony Parent of Parent and Win LLP, the IRSMedic, and I thank you for watching.